So after the consumer price index is released, we have the lowest mortgage rates now in 4 months. Does that mean rates are going to continue to drop? Does that mean the housing market is going to recover and go back into boom? I don't know. Let's take a look at the data. I'm Bill Gross. I'm a real estate broker in Los Angeles, California, and this is my weekly real estate insights. And it's important to look at the data. I think there's a lot of news in real estate that I think is worse than the political news in terms of misinformation. And we have to really look at the data, understand what's happening. Let's go into it in detail. So what we did experience on this week was after the consumer price index came out, we had the lowest rate, 6.07 as I speak here now, the lowest rates in the last 4 months. We have to go back into September 15th to see rates where they are now. So for all the huffing and puffing for the last 4 months at least, we've come back about a quarter of the way from where they were record lows last year. And that means lower payments for buyers prospectively. Those in escrow are going to see a little savings right away. Those that bought houses 3 months ago, 2 months ago, are either able to refinance or will be able to refinance real closely. So it certainly makes the market more energized and energetic and ready to go. How's the market overall? Well, it still continues to be very healthy. Take a look at the inventory levels. 2023 number is still below the prior numbers from 2021 and 2022. So we are at historic lows in terms of overall inventory. There we are on it. And then you can see that all the pandemic years are below the prior pandemic years. So while inventory might be a little higher than last year overall, oh, here we are, 2023. While it's a little higher than last year, we're still well below the historic norms for overall inventory. Even truer in Los Angeles, you can see inventory both is now below 2020, below 2019, higher than it was last year. Again, that was an aberration, but notice the trend line, the inventory is still tightening. So we still have in Los Angeles a very healthy market. I had a buyer just yesterday call me, an investor in a property over $1 million, where there were numerous people bidding on the property because if it's priced right and ready to go, there are plenty of people still looking to buy property and get involved. Now, what does the housing market look like? I found a great analogy that I wanted to share with you guys I think might be helpful to understand. As an analogy would be the used car market. Notice this is the value of a car. So if a car was worth $100 back in 1997, you can see that over time prices have gone up. And pre-pandemic in 2019, the car prices, the value was like $150 for a car. Just imagine that's what a car was worth. And during the pandemic, initially it dropped, and then boom, if you remember, you couldn't find used cars. And that same car that was worth $150, perhaps was worth about $225, $275 at the peak last year during the peak of the pandemic. And now it's been dropping dramatically back to a value of $219 compared to the $150. So you can see the value of cars is still higher than it was pre-pandemic by about 50%. A drop from the high, a significant drop, but you wouldn't say that market crashed, you'd say that market has corrected. And I think that cars move more quickly in the market because there's less length of time in a transaction. Buyers go in and buy a car within days or weeks, not within months like they do in buying a house. And also, the car buying isn't as tied to appraisal differences. We have appraisers that look at data going back a month, 2 months, 3 months for houses. Cars, they have market data that week and the week before. So the appraisers kind of hold back the value of prices in the housing market and the way they do in the car market. But notice that the car market went way, way up. It has come down some of it. Still, the majority of the gain kept in the value of the cars. And so I think with homeowners still, the majority of the gain is still in their pocket. Now, what's shocking to me is the effect of the negative news on consumers. Take a look at this chart. This I found fascinating. Historically, most people thought it's a good time to buy a property. This goes back to 1982. I started the business in 1986 myself. And you can see historically about 70% of people, of consumers, that was a good time to buy. And then now with the pandemic, that dropped right away in the pandemic and continues to be low to where now it's like less than 20% think it's a good time to buy. Yet people who think it's a good time, that it's a bad time to buy, historically has been low, 10 to 20%. During the pandemic rose. Now we know all those people were wrong. It was a great time to buy. and they missed out. And even still now, they continue to think it's too high. So one of the things that I think this measures is the raw emotion, not the numbers, meaning even where housing prices have been coming down lately, like the used cars, they haven't come down to below where they were pre-pandemic. And most importantly, they've held the value relative to inflation. Meaning, if you're not going to invest in your own home, where are you going to put the money? Stocks, they've taken a beating. Bitcoin, that's been challenging. Gold, very volatile. In the bank, inflation is going to eat that up. And so housing has been a great hedge against inflation on top of tax benefits, on top of the fact the tax gains are all deferred. And yet the majority of consumers, that was a bad time to buy during the greatest boom in the history of the housing market. So I think that that's the effect of the bad news in the news on consumers, while institutions and wealthy people are benefiting, the average person is being misled and missing out. Here's another, I think, piece of fake information that I saw in the news this past week. This is apartment data. Now, you may have heard that the number of apartments being filled has dropped month over month, and the occupancies have risen. So take a look at this, and this graph looks very scary. Big increase and then a decrease, below the line. But this is month to month. So all this is saying is in the fourth quarter of 2022, after a ridiculous record increase in 20, 21, and 22, it's again corrected, giving up a small piece of these huge gains over the last 2.5 years. So it looks very ominous to see a graph with a negative number. But when you take it, if you would just take it off of this piece here, for example, you would still see overall an increase. And that's the key thing to look at, is in perspective of what's going on in the last couple of years. Take a look at occupancy. It's been talked about how occupancy has declined to really almost historic levels. You have to go back to 2000 and the last housing pandemic or before. Oh, that's not quite true. 2013, let's say, to see where these numbers are. But again, this is occupancy now at 95% instead of at 96 or 97%. Keep in mind, if you're a landlord with 20 or 100 units, let's say 100 units, that's only one more vacancy. However, and it sounds bad, but however, I have 100 units as one vacancy, but the other 19 are paying more by about 30% over the last 2 years in most markets. Maybe not in rent control areas, but even there, the housing markets, when they replaced tenants, have gone up significantly, and the buildings have gone up significantly. So while the occupancy looks ominous, again, notice this graph, it starts at 91%. That exaggerates the differences. If this went down to 0, you would probably hardly even notice the differentials. But the graph is designed to scare you. This is from the Real Page Market Analytics. I don't even know what that is, but it's designed to scare you and think, oh, wow, look at their dramatic change. It's exaggerated by 10 times, as well as really, when you look at it in context, I think is overall insignificant. So at the end of the day, what's going on? Well, the market seems to have come back a bit in the mortgage rates to make it easier for buyers. Inventory remains tight, which means that housing values are still competitive. If it's a good time for you to sell a house, time to do it. You've got demand out there, and if you want to buy a higher price house or lower price house, the problem is right now, if you're going to buy another house, your mortgage rate, if you refinance in the 3s, is going to be in the 6s. So that's going to be uncomfortable. If you have a lot of equity, though, and most sellers have, that payment difference may not be so significant. If it's a good time to buy, if you have a good income right now, rates will come down about 0.5% in the last 2, 3, 4 months. And in the long run, housing has been a great hedge against inflation. So what's best for you? Depends on what's best for you. Look at your situation. Don't get caught up in the national news, which is very misleading. As always, I'm Bill Gross. I'm here to help you. Call, text, email. I'm on social media at BillGrossEXP. And as always, make today your best day ever. Thanks.